You know, a lot of Virginia Beach homeowners make this mistake. They hear that their home could sell for 450 or 500,000 or maybe even more, and mentally they sit there and spend that entire number. They picture paying off the mortgage, putting down a large down payment on the next house, paying off some debt, or finally having money left over in the bank. But then the closing statement arrives, and suddenly they are walking away with an amount that was very different from the number they had in their head. Not because someone necessarily hid the cost from them, not because the closing cost company made a mistake, and not because they were cheated. It usually happens because everyone focused on one question: what will my home sell for? When the far more important question was, what will I actually net after the sale? So, in this video, I'm going to walk Virginia Beach and Hampton Roads homeowners through the major expenses that can reduce their proceeds, show you how a seller can receive a strong offer and still be disappointed at closing, and explain what you should calculate before you ever put a for sale sign in your yard. And make sure you stick around till the end of the video, because one of the biggest expenses is not technically a closing cost at all, but it can still take thousands of dollars out of your pocket. Now, I'm Scott Stamper, the Cowboy Real Estate Agent, and let's get started. The numbers that get sellers in trouble. So let's start with the number homeowners naturally focus on, which is the sale price. Now, imagine that a homeowner in Virginia Beach believes their house is worth $475,000. They have approximately $260,000 left on their mortgage. They do some quick math, and $475,000 minus $260,000 equals $215,000. So in their mind, they are expecting to leave the closing table with approximately $215,000. But that is not how a real seller net sheet works. The calculation leaves out the expenses involved in preparing, marketing, negotiating, transferring, and physically moving out of the property. The sales price is the top line number. Your net proceeds are the bottom line number. And those two numbers can be very different. This is especially important for homeowners who are selling because they need the proceeds for their next move. You know, maybe you are downsizing from a larger Virginia Beach home. Maybe you are moving from Virginia Beach to Chesapeake, Suffolk, or North Carolina, or another state. Maybe you need a certain amount for the down payment on your next house. Or maybe you are selling an inherited property and multiple family members are expecting a certain amount from the sale. Now, in all those situations, guessing at your net proceeds can create a major problem. So, before we get any further, I just want to say real quick, I've created a Virginia Beach seller net sheet checklist that helps homeowners identify the major expenses they should consider before selling. So if that's interesting to you, comment the word net below this video or send me a direct message with the word net, and I'll send you a copy today. It will help you estimate what you may actually walk away with instead of planning your next move around the sales price alone. Okay? So let's get back to it. You know, let me give you a realistic example here. This is not one specific client's private story. It is a situation that happens regularly in real estate. A homeowner starts thinking about selling. They look at Zillow, see what a few neighbors sold for, and decide their home should sell for approximately $500,000. Now, their mortgage balance is around $300,000. They believe they are going to walk away with roughly $200,000. Based on that number, they begin looking for their next home. They tell a lender they will have around $200,000 available. They start planning a large down payment. They may even promise part of that money to pay off a vehicle, credit cards, or another obligation. Then an offer comes in. The offer is close to $500,000. So they feel like everything is working exactly as they planned it. But the buyer also requests closing cost assistance. The home inspection uncovers several items. The seller agrees to make a few repairs. There is a remaining mortgage payoff, prorated taxes, settlement expenses, negotiated real estate compensation, moving expenses, and possibly an HOA related charge. By the time everything is totaled, the amount the seller received is much lower than the original $200,000 they were expecting. Again, the issue was not necessarily that expenses were hidden. The issue was the seller built an entire moving plan around the wrong number. They planned around the price instead of the proceeds. That is why I believe every homeowner should receive an estimated seller net sheet early in the process and not 2 days before the closing date. Now, your mortgage payoff. The first major reduction is normally the mortgage payoff, right? Notice I said payoff and not simply the balance shown on your most recent mortgage statement. Your actual payoff can include interest through the payoff date and other charges connected to the loan. If you have a second mortgage, home equity loan, home equity line of credit, judgment, tax lien, or another recorded obligation that may also need to be addressed before clear title can transfer, this is one reason you should not rely entirely on a rough number from an online mortgage account. A professional net estimate should use the best available payoff information and still explain that the final payoff is determined by the lender. Now, number 2, real estate compensation. Another major expense may be the compensation connected to selling and marketing the home. Real estate compensation is negotiable and should be clearly explained in the listing agreement. Depending on the terms of the transaction, a seller may also negotiate whether to provide compensation or concessions connected to the buyer's representation. The important point is not to assume anything. You should understand exactly what you are agreeing to, how it affects your proceeds, and what services are being provided in exchange. A good seller consultation should not simply tell you that your home might sell for this. It should show you how different offer structures affect what you keep, because an offer with a higher price is not automatically the offer with the highest net. Now, number 3 is seller concessions. Seller concessions are another area that can surprise homeowners. A concession is generally money or credit the seller agrees to provide as part of the transaction. It may help cover certain buyer expenses, subject to the contract and financing requirements. For example, imagine you receive 2 offers, right? Offer A is for $475,000 with no requested closing cost assistance. Offer B is for $485,000 but requests $12,000 in seller paid costs. At first glance, offer B appears to be $10,000 better. But after subtracting the requested concession, its effective starting point is $473,000 before comparing any other terms. That does not automatically mean offer B is bad. There may be other advantages. But it shows why sellers should never choose an offer based on the headline price alone. You must compare price, concessions, financing, appraisal risk, inspection terms, requested repairs, closing date, and your estimated net. The strongest offer is the offer that best supports your goals, not necessarily the one displaying the largest number at the top. Now, number 4 is repairs and inspection negotiations. The next category is the repairs, which I just said. Some homeowners assume that once they accept an offer, the financial negotiations are finished, but often they are not. Depending on the contract, the buyer may conduct inspections and request repairs, a credit, a price reduction, or another resolution. A home that looks perfectly fine during normal daily life can still produce an inspection report containing dozens of observations. That does not mean every item must be repaired. It does mean sellers should prepare for the possibility of another negotiation. This is where planning matters. Before listing, you should consider obvious maintenance concerns, safety issues, active leaks, damaged wood, heating and cooling problems, moisture concerns, broken fixtures, and other items that may alarm buyers. You do not necessarily need to renovate the entire property, but identifying potential problems early gives you more control. It is usually better to decide how you want to handle an issue before you are under contract, working against a deadline, and worried about losing the buyer. Now, number 5 is taxes, settlement, and transfer related charges. A Virginia home sale may also include settlement, title, tax, deed preparation, mortgage release, transfer related, HOA, condominium, or other transaction charges. The exact amount depends on the property, location, contract, closing company, association liens, and the specific transaction. Virginia law also imposes taxes associated with recording and transferring real estate, although which party pays particular charges can depend on the type of tax, local practice, and the contract. This is why I would be cautious about using a generic national closing cost calculator and assuming that it gives you an exact Virginia Beach number. It may provide a rough starting point, but it does not know your mortgage payoff, negotiated terms, association fees, liens, repair decisions, moving timeline, or the specific offer you will accept. A customized seller net estimate is far more useful. Now, the cost many sellers completely forget. Now let's talk about an expense that is not always listed as a closing cost, but can still reduce your proceeds significantly. Moving. Selling the house and moving out of the house are two separate financial events. You may need to pay for movers, a truck, boxes, storage, cleaning, temporary housing, utility deposits, travel, pet arrangements, or time away from work. If your new home is not ready when the old home closes, you may also need a short-term rental, a hotel, storage unit, or negotiated post-settlement occupancy arrangement. And timing can create additional costs. For example, you may close on the new house before the old one closes. That can create overlapping mortgage payments, insurance, utilities, and other expenses. Or you may sell first and need somewhere to stay before purchasing the next property. This is why your selling strategy should include more than the price. It should include the financial plan and the timing plan. All right. Why a higher sales price can still produce less money. Here is another mistake sellers make. They assume that holding out for a higher price will always leave them with more money. But suppose your home could realistically sell at $500,000 in its current condition. You decide to spend $25,000 on upgrades because you hope to sell it for $520,000. Even if you successfully receive $520,000, you spent $25,000 to increase the price by $20,000. You may have created more work, delayed the listing, and reduced your final net. Or suppose you reject a clean $490,000 offer because you want $500,000. Several weeks later, you accept $500,000, but the new buyer asks for $12,000 in concessions and negotiates $5,000 in inspection items. The higher price offer may actually leave you with less. This is why I tell sellers that price matters, but price without context can be misleading. The goal should not merely be to brag about the sales price. The goal should be to achieve the best combination of proceeds, certainty, timing, and acceptable risk. All right? So, how to avoid the closing cost surprise. There are 4 numbers I believe every Virginia Beach seller should understand before listing. Number 1 is the estimated market value range of the property. Number 2, the approximate mortgage and lien payoff. Number 3, the expected selling expenses based on the likely transaction. And number 4, the estimated proceeds under more than one possible scenario. I recommend looking at least 3 scenarios: a conservative scenario, a likely scenario, and a stronger than expected scenario. Your net sheet should also be updated when the terms change. When an offer arrives, calculate the net based on that actual offer. If concessions are negotiated, update it. If repairs are agreed upon, update it. If the closing date changes and affects your payoff or moving expenses, update it again. A seller net sheet is not a guarantee. It is a planning tool. But a thoughtful estimate is much better than building your next move around a guess. So, my last thing is, before you ask, what can I sell my Virginia Beach home for? Ask the question that actually controls your next move. What am I likely to keep? The sales price may get the attention, but the net proceeds determine what you can do after the sale. So if you're thinking about selling a home in Virginia Beach, Chesapeake, Suffolk, or anywhere in the Hampton Roads area, please just comment the word net below and I'll send you send me a direct message with the word net, and I'll send you my Virginia Beach seller net sheet checklist today, so you can identify the expenses that may affect your sale before they become unpleasant surprises at the end. And if you would like a personalized home selling estimate, I can help you compare your likely sales range, potential selling expenses, and estimated proceeds based on your property and your moving plans. Now, there's no pressure and no obligation with this, all right? The purpose is to give you a clearer financial picture before you make a major decision. And if you found anything in this video helpful, please just subscribe to the channel for practical Hampton Roads real estate advice for local homeowners and sellers in this area. Now, I'm Scott Stamper, the Cowboy Real Estate Agent, and I help Hampton Roads owners, homeowners, make smart, informed financial real estate decisions. And remember, give a like and subscribe if you found anything in this video that was helpful. And I'll catch you down the road.